Hello, I'm David Chaston with 90 at 9, brought to you by interest.co.nz. This week, get everything you need to know in 90 seconds at 9 o'clock. With news, investors are pulling out of equity markets as risks pile up. Bond markets are the beneficiary. First, however, American retail sales in September have come in weaker than expected. In fact, instead of rising marginally, they fell from August. Year on year, they were up 3.8%, and that was sharply lower than the 4.5% annual rise in August. Markets weren't impressed. And not helping was data that shows inventories rising faster, up 6% year on year. In Canada, their CPI came in at 1.9% in September, stuck at the same level now for 7 straight months. It will probably mean that the Bank of Canada rate will stay at 1.75 at its next review on October the 30th. In China, there are reports that office vacancy rates are starting to rise to worrying levels, even in their top-tier cities. In Beijing, it is approaching 10%. Surging supply is overwhelming flagging demand. They don't need a commercial property crisis right now. The EU also released inflation data overnight, and that came in at just 0.8% in the year to September across the whole bloc, and that was lower than expected and down from 1% in August. And there is a summit of EU leaders about to start, and of course the main issue is Brexit. The pre-leaders meeting negotiations are intense and no one has walked out as yet, so these down-to-the-wire talks must be making progress. On Wall Street today, equity prices are lower, not by a lot, but the S&P 500 is down 0.2% so far. A resolution of the General Motors strike is making no difference to the mood. That follows European markets that were mixed, with the German DAX up the most and the London FTSE down the most. That's of the majors. Yesterday, both the ASX and NZX were the stars, rising 1.3% and 1.2% respectively. However, American investors generally are showing real concerns about the trade wars and have pulled about $60 billion out of equity markets in the September quarter of 2019. In the September quarter of 2018, they added $20 billion into those equity markets. The bearish turnaround represents the largest pullback since 2009 in the GFC. Meanwhile, in the same period, bond funds recorded a net inflow of $118 billion, double the same pace of 2018. The US Treasury 10-year yield is down 1 basis point to 1.75%, and gold is back up today, up $10 overnight to $1,489 an ounce. US oil prices are little changed again today at just under $53.50 a barrel, and the Brent benchmark is just on $59.50 a barrel. And the Kiwi dollar is little changed as well, now at 62.9 US cents. On the cross rates, we're just under 93 Aussie cents, and against the euro, we're lower at 56.7 euro cents. That puts the trade-weighted index at just on 68.1. I'm David Chaston, and that was 90 at 9, brought to you by interest.co.nz.